Hello, investors. It's Don Vandenbord, Chief Investment Officer with Revere Asset Management. Today is Monday, April 1st, 5:10 p.m. Eastern Time. Coming to you from St. Augustine Beach, Florida, with the Revere Roundup Daily Market Insight video, the No Foolin' edition. So, state of the market. We're in an uptrend going all the way back to the beginning of November when we had back-to-back O'Neill follow-through days. You can see the trend gauge over here. We've got the coveted 4 green arrows, yellow sub arrow on market leaders as we've seen a recent lack of relative strength on a bunch of the stocks, most of the stocks that led from the get-go back from the beginning of November. Still, they've been replaced. Those were mostly tech-related names. A lot of them have been replaced with non-tech names. So rotation is healthy in a bull market. But if you are banking on continued gains from something that ran up hard, that's not what you've been getting over the last month. However, the 3 major indexes are still in uptrends across all three, the 5 major indexes across all 3 time frames that we track, that being the 21-day short-term moving average, medium-term 50-day moving average, long-term 200-day moving average. So what happened today? Well, PCE data, that's inflation data, came out Friday morning, and the market was closed. And it was mostly in line. One of the components was less than expected, but they did increase the inflation numbers from previous months. They were revised higher. But when the futures opened Sunday, it was initially greeted positively. S&P up between 1.5%, NASDAQ a little bit more. All through the night, that stuck. But around 7 o'clock in the morning, things started to peel off. And I did notice when I checked the futures last night that although the futures were up, commodities were also up, and yields were up. So when you see when you see yields being higher, you always have to take the fact that stocks are up with a little grain of salt. I didn't see a quote on the dollar at the time, but as the morning rolled around, the dollar was higher as well. So dollar higher, yields higher, and stocks higher. Something normally has to give up. And what happened was we ended up opening near flat on the indexes, rallied a little bit, but then several waves of selling hit, and really a disappointment for the bulls, but a disappointment that can be explained away because of yields and the strong dollar. And this is something we've been talking about for a while, that normally they can't get along, rising yields, a stronger dollar, and stocks. And today was a classic case of, as the dollar got stronger and yields stayed strong, that the S&P weakened. The exception was the big 7, 6 out of the 7 green. They don't really care that much about yields because their balance sheets are rock solid. Rising yields typically affect companies with a lot of debt. So strong balance sheet, good stuff, place to go in times of uncertainty. Here are the final numbers on the day. The big 7 up 0.81%, and this really masked the weakness in the S&P, and very clearly on the NASDAQ, this is responsible for most of the gains. That and semiconductors were strong as well. 6 out of the 7, just Apple, the lone red spot in the big 7. RG8, ugly from the outset. All 8 of them red on the day, down 0.70%. We don't like to see that, obviously. S&P opened barely positive, little bit of a rally, then 5 ways down in the morning, little bit of strength into the close, but all in all, a disappointment, down 0.2%. Equal weight, this is more in line with reality. Equal weight down 0.6. NASDAQ 100 on the back of the big 7 up 0.21%, equal weighted down 0.26. Dow down 0.6, mid caps down 0.7, Russell 2000 small caps down over 1%. Global 60/40 down 0.36%. In-house GROTECTION down 0.12%. And we'll take a look at the charts and what was responsible for the gains and losses as we move along in the video. And let's just start off now with the S&P 500. Let's go to a 5-minute chart, and you can see the mild open, little bit of a rally, couldn't get above Friday's high. Then at 10 o'clock, ISM manufacturing report came out, and it was much stronger than expected. That took stocks lower, as that's going to reduce the probability of the Fed cutting rates. And there was 1, 2, 3, 4, 5 waves down before we bottomed at 52.29. Attempted rally, pullback, at least 52.29 held during the early afternoon pullback. Then some higher highs and higher lows before a decent close. But all in all, a disappointment for the bulls. Leading stocks mixed, really not overly bad as far as the individual names go. But the concern is the dollar and the rising rates. And we'll look at those charts as we move forward. Here's the NASDAQ 100. This had a very nice gap up, faded, bounced at the 8-day moving average. We've been talking for a while about this. It's minor, but it's there. Relative weakness. Although we're making higher highs on a relative basis, we haven't been going all the way back to the middle of January on the NASDAQ 100. But closing mid-range today, bouncing at the 8-day exponential moving average. Dow Jones Industrial Average, down 0.6, still above the 8-day moving average. And you can kind of see the shelf that's being formed here. That's really the same thing on the S&P. The breakout is holding that 51.74, and now the 21-day moving average closed today at 51.73. So this is a big area of support right here, and it needs to hold. You can see 1, 2, 3, 4, 5, 6, 7, 8 days in this trading range now. And overnight broke above it, but in fact, the futures made an all-time high overnight, but by the time we opened, we were back inside this range. So this is the range that we're tracking right now. And if this gives way, we'll be getting more defensive. On to mid caps. Here's the mid cap ETF, down on the day, down 0.72%, still above the 8-day moving average. This has been showing relative strength over the last week and a half. And small caps, disappointing day today, giving up that 210 level. So as of right now, this is a false breakout above the highs back from late February, and we'll see how it interacts with the moving averages that are coming up to meet it going forward. On to, well, we'll do the VIX first. VIX was up. VIX was up all day, even in the morning when always be wary when the VIX is higher and the indices are higher. And same thing on the downside when the VIX is lower and the indexes are lower. You've got one of them is going to have to give. In this case, the VIX did come off a little bit, but closed higher as the indexes faded. VIX up 4.9% on the day. Now, here's where the trouble starts. The U.S. dollar breaking up to month ago highs, this 105 level. So this strong pullback coincided with the move up in the markets. Markets continued to move up while the dollar got stronger. But this is really what's been holding the market and leaders back over the last couple of weeks, is this strength in the dollar. So now we monitor this 105 level and see if we pull back or if we continue to gain strength. We've been mentioning how the precious metals, in the face of a strong dollar, have been acting fine, and they were higher again today. Gold up by 1%, GDX up by 1.3%, closed mid-range. Silver, SLV up 0.5%. Bitcoin laggard on the day, undercut but reclaimed the 21-day moving average by the close. We'll be watching the lows of today relative to the 21 on Bitcoin. We actually are trading IBIT, and that looks different from BITO. I think there was a role in the Bitcoin futures, and BITO is part of that. So I probably need to start going just by the IBIT chart. As you can see, this is only just an undercut at the 8-day moving average, while BITO, which is made up of multiple futures contracts, all the way down at the 21, showing more weakness. Down BITO down 5%, IBIT only down 1.78%. So a divergence there. All right, Bitcoin. Now on to bonds. Big move down in bond prices, down to the bottom of the range. This means prices come off, means yields higher. Let's go to TLT first. Also down to the bottom of the range, down 2.2%. Now we'll go through the yields, and you can see we're up at the top of the range on yields now. Will the top of the range act as resistance and we'll pull back, or will we bust through the top? The Fed can only control short-term interest rates. All three of these charts that I show, the 5-year, the 10-year, the 30-year, these are longer-term rates, and they're determined by the market. So there's the 30-year, TNX is the 10-year, also up near the top of the range. FVX is the 5-year, also at the top of the range. Cause for concern, something we monitor. Interasset correlation is not to be ignored. We've just seen it happen too many times in the past that this correlation impacts what's going on with the markets, and it just makes too much sense. You need to pay attention to interest rates if stocks that are borrowing a lot of money are seeing their borrowing costs tick up. So the market reacts that way. Some worsening of the stochastic data. Some news, I mentioned the PCE inflation and the ISM manufacturing data that came out at 10 o'clock. Day count, day 8 in the range after the breakout. We're still holding the breakout. And I talked about the intraday action sectors on the plus side, gold and gold stocks, semiconductors, uranium, and oils. On the downside, banks, defensive sectors, PUVRE, that's staples, utilities, healthcare, and real estate, cybersecurity weak, biotech weak, although it bounced, and ITB weak with rising interest rates. 2 changes to the portfolio. We added to Micron as it got an upgrade and was strong all day, and got back into energy with a non-leveraged ETF, VDE. So ticking up the beta from 1.44 to 1.48. Bottom line on the day, the first day of the second quarter, Q2 day 1 yields mixed results, but some caution with the yields and the dollar spiking. Now let's take a look at the portfolio, the GROTECTION portfolio, and a few other charts. One thing I want to note is TVH. Luxury retail has been doing pretty well, and this chart looks great. But after hours, Phillips Van Heusen, they make Tommy Hilfiger clothes, I believe, down 20%. They warned this will likely pass through to things like we see Ralph Lauren down 3.6%, another luxury lifestyle brand. We own Gap, not luxury. It's down 0.5% after hours, but we'll be watching this closely as the prevailing the conventional wisdom has been that the clothing manufacturers and across the board, the consumer is just fine spending a bunch of money. But so this PVH warning is kind of out of the blue, and it's something that we'll pay attention to. All right, portfolio. VDE, this is the chart that we added. This is energy. It pulled back to the 8, bounced off the 8, and made a higher high, breaking out of this cup. So this is a very small handle. It doesn't even, not even long enough to register on the chart here before breaking higher. Micron, one of the very strong stocks today, upgrade, double average volume up 5.44%. This has the potential. Look at all this volume here. Look at the earnings growth for 2025. Potential to be, it's got the fundamentals to be a leader, and the action after its earnings gap up has proven the strength. Now we'll just go through the portfolio, the rest of the portfolio. NVIDIA, continuing to consolidate. Really 3 days of tight closes here, under the 8-day, above the 21-day. FCX copper continues to be strong, but it reversed and closed at the bottom of the range today. Uber, this is what I've been talking about with the early leaders off of the bottom. You can see how strongly this ran after its double bottom breakout back at the beginning of November, one of the first ones to run. Now it's coming back. It actually is on the 10-week moving average, still above the 50-day, but this lower highs on the relative strength has been a consistent theme with a lot of the big leaders. And in this case, it's not just tech, as Uber is, well, it's a tech company, but it provides rides for people and delivers stuff. So not pure tech. So there's Uber, CrowdStrike, another one that's been making lower highs on the relative strength scale. It bounced at the 50-day moving average today. Eli Lilly broke the 21-day, bounced at, let's show the weekly chart. You're seeing a lot of these leaders come back to the 10-week moving average here, and it's a perfect place for them to bounce and go higher. Or if the market's going to weaken and it starts living below the 50-day, it'll be time to say goodbye to it in the portfolio. We showed Micron, we showed Gap. Those are the 7 names that we own. A couple of other standouts today. SMCI had a nice day, holding the 21-day moving average in that 1,000 level. Dell had a really nice day, above the 8-day exponential moving average, up 4.85%. CCJ, uranium. CCJ got an upgrade. This is a break of the downtrend line here on nice volume. So we'll be paying attention to uranium. If we play it, we'll be playing it with uranium because the ETF owns some spot uranium or some physical uranium, and that's something we find attractive as far as going into an ETF instead of an individual name, not to mention getting rid of the single stock risk. CCJ is still the big swinger inside uranium as well. What else had a good day today? AMD trying to hold the 50-day moving average, moved up a bit. Win, nice move up today on above average volume. This certainly has our attention. You can see that big cup and handle that it's forming. Shake Shack had a good day. Off of the 21-day moving average. ANET, networking stock, back above the 21 after testing it last week into that 300 level. This is a very short, flat base here that it broke out of before pulling back to the 21 last week. And of the big names, Google has totally shaken off this downtrend from the ridiculous response that its AI Bard product was bringing, and it's very clearly been bought up off of the 200-day moving average. It's an industry titan. Titans off the 200 is something we talk about a lot, but breaking out above this pivot. So good for you, Google. General Dynamic, GD. Breakaway gap today on above average volume. That's going to wrap it. As always, like to hear from you. The email's don@revereasset.com. The phone's 855-REAL-WEALTH. That's 855-732-5932. If you're interested in becoming a client, email my partner, Dan Stewart, dan@revereasset.com. Flagship portfolio is named GROTECTION. It's designed with a dual mandate: grow assets by being in leading stocks and leading sectors during market uptrends, and protect during market downtrends, especially if you break this ominous black line, which is the 200-day moving average. It's below this line that all bear markets happen. And with that, I'm going to wrap it for the first video of the second quarter, April 1st. This is Don Vandenbord with Revere Asset Management, telling it like it is. Thanks for listening, and have a great day.